Hello and welcome to our webcast. Moss Adams is pleased that you joined us for today's webcast, Spring 2024 Not-for-Profit Accounting and Auditing Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Matt Dinsdale and Ryan Woods, both senior managers here at Moss Adams. Their bios and contact information are located in your console if you would like more information. Now, I'd like to turn the floor over to Matt to get the presentation started. Matt.
Thanks, Danielle. So today's agenda includes talking about uniform guidance and Department of Education updates. There were some recent changes and new guidance put out, so we'll go through that. We're also going to spend a little time talking about IT general controls, a very hot topic. We'll go through some accounting updates on new accounting standards updates that have come out recently and just walk through some guidance on that, and then some changes to accounting rules. All right, so today's objectives, by the end of today's session, you should have a good idea about the uniform guidance changes that were released on April 4th, 2024. We'll go through a number of slides to talk about the detail of those changes, and by the end you'll have a good idea about how they may impact you. We'll also go through IT general controls. Part of those uniform grant changes was the requirement to include IT general controls within your accounting and control systems. So we'll go through what that is, what those controls look like, and some of the terminology often used when you're talking about IT general controls. You should also have a good idea about new accounting guidance. We'll go through some overview of leases accounting, as well as credit loss accounting, as well as some other items that may impact you. And then, of course, there are some new audit standards that may impact your not-for-profit audits this year, mainly related to risk assessment and non-compliance with laws and regulations. All right, and first we'll talk about uniform guidance updates. But first we have a polling question. What type of organization are you? A, higher education, B, a foundation, C, a social welfare or charity, or D, other. We'll take about 45 seconds to answer the poll, and then we'll advance it. Just a reminder, you need to answer 3 out of the 4 polls today in order to receive CPE credit. Also, just so you're aware, we do have slides available. You can download them directly from this website. We'll also be sending out tomorrow the slide deck so you can have them for reference in the future. All right. And here are the results. About 25% of quarter of you are higher education, and then about half of you are other organizations. All right. Okay, so going on to uniform guidance. April 4th, there was a webcast that the federal government, the Council on Federal Financial Assistance, put out. We watched it live. I'm sure some of you may have watched it as well. It was just a very high-level summary of really the intent of these changes, what the federal government was trying to achieve when they spent the last couple years drafting up the changes that went live this year. They released a memorandum, M2411, which gives a little more information about it, but it really is intended to give direction to the different federal agencies on how they will adopt it. So each federal agency, whether it's Department of Education, Department of Energy, Health and Human Services, they will all be required to adopt those standards into their own regulation. And they must do it by October 1st. The effective date for this new uniform guidance change is October 1st, 2024 for any new awards issued as of that date. Different aspects of these changes will impact you at different times, and we'll kind of go into that. Okay. So the goals of the new revision were really to implement pre-award efficiencies and promote transparency and equity. The thought was behind this change is that historically, when you're applying for award, the pre-award process and the post-award process has been very complex and sometimes convoluted. It's required a lot of organizations to have an army of accountants and attorneys on hand to be able to decipher some of the requirements of these awards and be able to respond appropriately in order to be considered for awarding under some of these programs. So the thought is these changes will help reduce some of those complexities, eliminate some redundancies and administrative burden to allow a broader and wider array of organizations to apply for them and be able to do so without committing a significant amount of their time in efforts to obtain this funding. So not only are they creating some efficiencies, they're also reducing the complexity in the awarding of grants, focusing more on how they deliver services versus proficiency in understanding the legalese and the regulations around it. They're also moved a lot of language to plain English, so reducing some redundancies, adding better definitions, revising definitions, and removing ambiguous statements. They're also trying to reduce the likelihood there's variations in how different regulations are interpreted. You may have noticed that your organizations interpret some regulation different from maybe a sister organization, and then maybe your auditor interprets it different from others. So its intent was really to reduce some of that ambiguity. You know what I'm saying? And then also reduce administrative overhead. All right, so changes to uniform guidance. So we're going into some specifics here in regards to changes. So the Notice of Funding Opportunities, the NOFO, the thought is that's a very complex and lengthy document when you're looking at a new award. And so they've created a template to reduce that down, somewhere from, say, 100 pages down to 10 pages. Again, to reduce the amount of time and complexity in regards to reading those opportunities and responding to them. Another large change was the increase of the threshold for single audit. So as many of you know, if you spend over $750,000 in federal dollars in a given year, you're required to undergo a single audit. So the new threshold will be $1 million. A lot of you probably will not have will be affected by this just because you're likely well over $1 million. But there are a good chunk of organizations that fall between those two limits, and they'll no longer need to have a single audit. The threshold for equipment is also increased from 5,000 to 10,000. So the requirement to track that equipment will be increase and reduce some of the overhead related to tracking smaller equipment items, as well as unused supplies threshold is increased to $10,000. Many of you calculate modified total direct costs as part of your indirect cost calculation, and you may be well aware that amounts over 25,000 of subaward costs have to be excluded, and that the threshold is now increased to $50,000, which will essentially mean more indirect costs can now be captured for the purpose of indirect costs. So there's increased emphasis on data reporting. There are some other changes in language around websites that could be referenced as part of the regulations. Also, all recipients will need to register for a UEI, a UE identifier now as part of the Transparency Act. This was already a requirement, but it's been brought forth as a more kind of stringent requirement. Expansion of whistleblower protections. And this next one, internal control must include cybersecurity and other measures to safeguard information. Obviously this has always been a focus, but it's now written into the regulation. So it's something you should really make sure that you're doing what you need to do in order to safeguard your data. There's also some changes around clarification of the contract between a federal government and a subrecipient. There's no contract between the Fed and a sub. It's the pass-through organization holds the contract with both entities. So a clarification, many of you put your corrective action plans on letterhead. That was commonly thought of as a requirement, and there's been a clarification that was actually not a requirement. It was just some kind of information that got out there that wasn't quite accurate. Type A threshold. So this is more of an auditor item, but the threshold in determining a large program versus a small program, type A and type B, has increased to $1 million as well. And that maybe what this means is fewer programs to be audited. So just something to look out for there. Removes a prohibition on using geographic preferences when procuring goods and services. So you can now essentially focus in on local vendors when you're procuring services. De minimis rate. So some of you may use a 10% de minimis rate when you're calculating indirect costs. That's increased from 10 to 15%. So essentially a larger amount captured for your indirect costs. Another big one this year is the allowance of individual federal agencies, your cognizant agency, to award extensions on a single audit when there's undue burden. So this is not a situation where, didn't get closed fast enough and maybe, auditors are delayed or something like that, and you need more time. This is more of there was a natural disaster, there was some major event that happened locally or something like that that required additional time, and you're asking for an extension. This has kind of come out of the last 5 or so years when we saw COVID extensions and we saw other extensions throughout the period, related to data collection form. So these kind of have created an opportunity really for organizations to request an extension when there is undue burden. You can also now amend your purchasing policies to now include veteran-owned businesses as a preference. So great news there. And there's some other minor changes I won't go through because we don't have that much time, but we essentially more plain language modifications, really trying to clarify certain things that have caused confusion in the past. A good example of that is a non-federal entity that has a very specific definition, but it can be interpreted in many different ways. A non-federal entity really means it's a recipient of federal awards. And so that's been changed within the guidance to really make it simpler for those to understand what types of entities are susceptible to these uniform guidance rules. All right. So polling question 2. What are you looking forward to with the new UG updates? A, change in audit threshold, simplification of the notice of funding opportunity, increase in de minimis rates from 10 to 15%, or option to apply for an audit extension. Also a reminder, if you have questions, please feel free to submit them in the Q&A. We'll do our best to respond to them as we're going through these, through this presentation. Should anything not be answered, we'll of course do our best to respond to them afterwards. So you may receive an email from us just responding to your question. If we have time at the end, we may go through some, but there's a lot of content today. So chances are we'll be reaching back out to you if you're not responded to during the presentation. All right, change in audit threshold. Looks like 47%. That may mean more of you than not may be impacted by that threshold and may not need an audit in the coming years. And I'll just take a moment to just clarify. There are a lot of questions about some of these changes, right? The threshold change for a single audit, the threshold change for a equipment, things like that, and questions mainly about when is this going to be effective? We don't know yet. There is no indication from the federal agencies or any of the federal oversight agencies on when these changes take effect. They are expecting to release some Q&As and some FAQs related to these questions, right? So when does a single audit threshold take effect? Is that June 2025? Is that December 2025? We'll hopefully find out soon. And then, of course, keep updated with us, and we'll send out notices and maybe write something on our website in regards to some of these clarifications. Okay, so switch it over.
All right, thank you, Matt, for going through those UG updates. We're going to hop into Department of Education updates, just spend about 5 or 6 minutes on this. So those 25% of you in the higher ed space can zone in a bit more into this section. Hopping straight in October, the DOE, Department of Education, did amend certain components of the Title IV to the Higher Education Act. These are effective July 1st, 2024. The first category, jumping straight in, is related to financial responsibility. And so high level, the department stated clearly its intent with these rules was primarily to protect students and taxpayers from the negative effects of a sudden college closure. So now there are certain triggers that inform the ED of potential concerns. These triggers are categorized as mandatory or discretionary triggers. So there are now 14 mandatory triggering events, which there used to only be 4. Each have a varying level of outcomes. However, a majority of these do result in a letter of credit type request from the ED. There are also discretionary triggers. Unlike the mandatory ones, they are designed to identify situations which could be a sign of financial weakness. And so those could merit some financial protection and offer a case-by-case basis and a look at the situation to determine whether it actually represents a significant risk. So oftentimes there's response opportunities for those. Next, thinking there are some revisions to administrative capabilities and procedures to ensure they are followed. However, we're going to hop straight into the next slide here, into the certification procedures. There are changes to create a more rigorous process for certifying institutions to participate in Title IV programs. So it's related to the renewal process for institutions to continue participating in Title IV. There are also disclosures related to programs that promote educational requirements for professional licensing and preventing institutions from withholding transcripts in many situations. There are also lastly, the amendment expands on mechanisms through which individuals without a high school diploma can access federal student aid via the ability to benefit alternatives. On the next slide, the compliance supplement for 2024, I'm sure you've heard, was just recently released, which has some changes related to student financial aid. A few of them we're going to briefly cover. Related to disbursements portion is a special test and provision. There are now requirements to test students that had credit balances and test for compliance with how those credit balances were handled. Now, a separate sample that auditors will make, you can't leverage existing sample areas. Institutional eligibility is a new compliance area added. However, this section is really inquiry-based to ensure there's no correspondence courses or incarcerated students receiving financial aid or else going through an additional assessment there. Next, compensation incentive testing. That was a new section added in the prior supplement. In 2024, there are some revisions, just clarifying areas that were a bit unique or unclear in the prior supplement. Lastly, there's certain removed requirements related to additional locations, special testing, satisfactory academic progress, special testing. Also, a lot of COVID-19 references were removed. I'll just note there were some discussions throughout the year on changes to auditor reporting to the ED, and ED was considering adding set steps for testing reporting on foreign gifts or compliance with safety and security statistics. We've talked a bit about that in the past. However, these sections were not added to the new compliance supplement. All right, the last ED update to touch on is just a few reminders and new information to cover. As a reminder to your financial responsibility ratios in that statement, supplemental schedule, every financial element must be cross-referenced to some quantitative element directly in the face of the financial statements or in the notes to the financial statements. There are often times where this notes should be added in order to cross-reference directly to the schedule. I would just say from practice, it's getting more challenging to tie out, pre-post implementation information in those disclosures. Might have to get a bit more complex and added to ensure they're properly disclosed and referenced in the financial statements. As for new requirements, a larger one is related to disclosures surrounding related parties. Related parties as defined by the FASB. The Department of Ed now requires a broader set of disclosures in the notes to the financial statements compared to GAAP. So these broader disclosure requirements include identification of all related parties, the name, location, description of the related party, and the nature and amount of any transactions between the related party and the institution, regardless of when they occurred or regardless of amount. All right, with that, I know it's a quick, really high-level overview. Wanted to make sure we touch on that. I will pass this back over to Matt.
Great. Thanks, Ryan. All right, moving on. IT controls are obviously been very important for a long time, but at this point, most of you will have IT systems that you're heavily reliant upon to gather information, produce reports that are accurate and complete. And your auditors are probably relying on it too to also produce complete and accurate reports. And so as your auditor will really need to understand some of those, what we call IT general controls. And it's important for you to understand that too, and your system capabilities and what kind of controls you're looking at. So jumping into it, just a reminder on what a control is. It's really something to prevent something from going wrong. or detect if something went wrong, right? It's different from a process. A process is just something happening, right? A process can result in an error. A process can result in an accurate figure. But the control is what happens to ensure something's accurate or detect something that's incorrect. So there's two really important types of controls. One's automated or systematic. The other one's manual. So an automated control is something that happens internally within the system without human interference. A good example of that is you're writing a journal entry, your debits have to equal your credits, right? That's a control to make sure you have a correct journal entry, or partially, at least it balances, right? So another good example is, maybe you have a system that does the three-way check between an invoice, a PO, and a packing slip, right? So that might happen behind the scenes to make sure all those items match. A manual control is something that requires human interaction, right? So it could be something that relies on the system or doesn't rely on the system. So manual control could be you going in and, let's say, approving someone's time card and then clicking approve within the system, right? That's, although it relates to the computer and it's reliant on the system, you still have to click a button that says you did something, right? Or you could have it completely outside of the system, right? Maybe reviewing a reconciliation that's manual, or reviewing a set of financial statements, something that's probably outside the system. All right, and just a general understanding of importance of IT. When you're looking at a financial system and financial cycle, a really good base is your IT controls, right? That's your foundation for your financial cycle. On top of that sits all your accounts, all your accounting system, and then of course your ending level procedures are on top, and those are things like tone at the top, or monitoring of your controls, or monitoring of your IT system. So evaluating risk, when we're talking about an information technology system, you can really kind of compare it to a watch. That's what we like to do here. You can see your network. Let's see here. It's a slide. So your network is really close to the casing of the watch, right? That's how it interacts with the outside. Application is your buttons, right? You're pushing those buttons to do something. Your database is your gears, the internal workings of your system. And your operating system is your battery, right? That's how it keeps running and how folks interact with it. Your internal control, your ITGC domains, there's really 4 that your auditors look at and you should be aware of. System development life cycle, your change management, security administration, and then of course your operations. So your system development life cycle, that's kind of how it sounds, right? That's developing a system throughout the life cycle, ensuring it's set up properly, approved throughout the stages of development, and it's working. If it's not set up correctly, then you can run into issues with, improper transactions, improper access, automated controls not working, key reports not producing accurate information, the wrong system being implemented, or maybe system without the correct capabilities being implemented. So when you have a new system, there's a long and very expensive process of making sure all those steps along the way are being addressed and go live is being approved. Change management. So this is the area that really is mostly effective in years where you have updates to your system, right? Systems get updated, right, with patches on a regular basis. But those patches, when you're talking about a system that's housed internally, have to be checked, right? They may not be implemented as soon as they're out to the public, because maybe there's a period of time where your IT group is assessing whether there's any glitches with it or any issues with that patch. And then once you go through the process of implementing it, you want to make sure that it's properly put into your system and working correctly. Otherwise, it can create other issues, right? A good example of this is the process of implementing a new patch. is kind of thinking about a self-driving car, right? There's unit testing, which happens on a coding basis, right? To make sure the code that you're now patching into the system is working effectively, is accurate. And then you have your user acceptance testing. That's more commonly referred to as beta testing, but just making sure that, when you are testing it, you're having humans testing it for the capabilities that you want it to be used for. And this more closely aligns with, a controlled city environment. And then you go real world, right? You go production. So after it's gone through testing, different stages of testing, then there's typically a go live date and an approval by your IT director to put it live. And that's when everyone uses it, and it just goes into the normal production environment. So there's approvals and processes and controls along the way to make sure that that new patch is accurate. Security administration, this really is always kind of very relevant to an audit, very relevant to your operations, is really knowing who has access to what system, right? You want to make sure that the folks that need that system access have it, right? And they don't have extra access. They don't have access beyond what's needed for their job. And then those access points have to be reviewed on an annual basis. Somebody's looking to make sure that there's nobody that was let go or left the organization that still has access, or vice versa. So it's good to check that on an annual basis. Also, it's important to understand operations. So this is how your data is backed up. How frequently is it backed up? Knowing those points is important, not only for the purpose of understanding your controls, but also if there's any recovery situation, where to go, who to talk to, and how long has time passed since the last backup. We listed some common controls here, but probably some of the more important ones. There's those user access reviews I mentioned earlier. User acceptance testing. If you have any kind of new patch, you want to make sure you test it. And then user roles and access review, just making sure folks have the right authorization. I'll also take a quick moment to mention SOC reports. A lot of systems are in the cloud now, right? So you don't necessarily have any visibility into the code or the updates or things like that. So you just want to make sure you're getting your SOC reports for those third-party administrators, those software companies that are providing you access to their software. They should have a SOC report, an audit of their own controls behind the scenes, so you can feel comfortable that your data is being protected and that folks are doing what they need to be doing to ensure accuracy and completeness of reports that are being produced and used in your financial operations as well as the audit. And just to recap, control is something that's done to prevent something from going wrong or detect something that went wrong. All right, so we'll go into polling question 3. What will you start looking into this afternoon when it comes to IT? Review your system access reports, make sure the folks that have access have the right access. Start tracking down SOC reports. Ask IT why I have never had to change my password. If you've never had to change your password, you should probably make sure there's regular changes of passwords. And then, of course, this afternoon, what are you talking about? I'm taking a nap after this. Just a reminder, 3 out of 4 need to be responded to if you want CPE credit. All right, happy you're going to look at your system access reports. Good, good. That's what we like to see as auditors. All right, Ryan, back to you.
All right, thank you, Matt. We're hopping into our accounting update. We have a few different items accounting related that we want to talk through. Just noting there's not really any significant standards that were recently issued impacting financial statements. However, one standard is currently being adopted by many not-for-profit organizations. That is the CECL standard. So we're going to talk through just some reminders. Yeah, you may have just adopted this. If you're December 31st year end, you may be looking to adopt it if you're an other than December year end. Talking about CECL, I just also want to note you've probably joined these webcasts and heard us discussing this before, but we really need to, hopefully the last time we could talk about it before it's fully adopted. As a reminder, the standard is replacing the current model for recording expected credit losses, moving from an incurred loss model to an expected loss model. We're going to dive deeper into that in a few minutes. This will have a larger impact on certain industries, really something like the financial institutions or industry. However, it does have some impacts in not-for-profit space. A reminder, the CECL standard is applied to financial assets measured at amortized cost. Here are some examples on the slide here. The largest impact we're seeing is on either loans receivable, if you have student loans or other loans to third parties. However, an even larger, maybe more common impact on not-for-profit organizations is on trade receivables. The receivables related to revenue generated from ASC 606 type transactions. So this can be tuition revenue or program service fee revenue if certain organizations have some sort of fee-for-service type arrangements. There are many assets, though, that are excluded from this new standard, including fair value measure investments or other assets measured at fair value. Also, pledges receivable is a pretty significant asset in not-for-profit space that is explicitly excluded from this standard. So what is changing? Again, the standard is going from incurred loss model to expected loss. So it's more a principles-based model, and it's essentially management's best estimate at a point in time for the lifetime expected losses for that related asset. The allowance for credit loss continues to be recorded net of the asset on the financial statement of financial position. It's also, all the changes are flowing through the statement of activities. A big change with this new standard is that management cannot rely solely on historical information. However, if using historical information could be used, but has to be adjusted for current conditions using reasonable and supportable forecasts. Again, instead of recording a loss as it happens, you're recording that loss up front, which reflects the entity's current estimate of all expected credit losses over the contractual term. The standard does not provide explicit guidance on the methodology, but does provide some flexibility for our organizations. However, there are a few models that are most common when estimating credit losses. You've got the discounted cash flow model, loss rate models, roll rate method, probability of default, and aging schedules. We did think it would be helpful to talk through one example, high level, that was put out by FASB related to trade receivables. We're going to talk through related to tuition receivables, but this could be easily extrapolated to any kind of accounts receivable that your organization may have. So historically, many universities or organizations will be recording the estimated losses based on the aging buckets. So we're going to walk through essentially how the new standard could impact your organization. So in this example, when implementing the CECL standard, the organization is going to be analyzing expected credit losses based on the aging buckets approach. The organization measures expected credit losses on a pooled basis. The pooled basis is because it has similar risk characteristics for its full population. I'll note the guidance does have specific requirements when assessing the pooling of assets. So first, again, establishing historical loss rate based on each pool of its receivables based on the aging buckets. The findings are summarized on this schedule here. On the next slide, essentially, we're adjusting that historical loss rate information based on current, reasonable, and supportable forecasts. Can't emphasize that enough. So there are potential factors, many potential factors that can be considered in estimating this. In this example, we're just noting that current economic conditions are declining, giving rising inflation rates and indicators of potential broader economic recession. Therefore, that loss rate is actually adjusted based on these supportable forecasts in each bucket by 10%. So you see a 10% increase in the loss rate in each bucket. That would then be considered the expected credit losses for all of those buckets at year end. I'll just note, obviously, there could be indicators and factors where you can adjust that loss rate down the opposite direction. I would also just note that that portion of the full model does have these significant management estimates and judgments that do come into play. I hope that's helpful. Some other items to note is that, again, if there's immaterial items that are scoped into this, the standard may not need to be applied, depending on just materiality. I'd also note that there's a very narrow exception when expecting a zero loss on a asset. The only real example that FASB has put out is related to U.S. Treasury securities, which has a zero loss because of specific guarantees that are associated with it. So would be very cautious to come to the conclusion of a zero expected credit loss. I want to touch on some new and required disclosures as a result of the standard. Requirements include, obviously, description of policies and the methodologies to determine the new expected credit loss. There's also a roll forward that is required on the allowance account. This roll forward is likely to be a new disclosure for many of our clients. It's not required for prior comparative year in the year of adoption, but it would be required for each period presented in subsequent periods. There's also some credit quality information, aging analysis, and other required disclosures that could be impacting your organization. Related to the adoption, you are required to use a modified retrospective approach. So essentially, think about that example we just discussed when you're assessing at year-end the expected credit losses for those assets. You would also perform that same analysis as of January 1st, the beginning of the fiscal year. And that difference from the new approach compared to the prior approach is flowing through the current year earnings, however, is disclosed as part of that allowance roll forward that you will have. Again, just a reminder, essentially, this standard is effective for current fiscal years ending December 31st, 2023 and onward. So likely you've just adopted it, going to adopt it, planning it, or hopefully maybe it's not effective for your organization. All right. Enough about CECL. The next slide we're going to talk through very quickly is on crypto assets. There was a new standard issued, 2023-08, related to the scope, accounting, presentation of crypto assets. So this does not impact the recognition, measurement, or derecognition of these assets. The standard clarified the scope of the assets. It must meet all of the following 6 criteria that are on this slide. So the bigger changes is that NFPs must present crypto separate from other intangible assets on the statement of financial position. Also, any gains, losses flowing through your statement of activities would be separated from other amortization and impairment of other intangibles. And from the cash flow perspective, must classify any cash flows from crypto assets as operating activities unless received in the financing capital. On the next slide, we essentially have a high-level summary of this new standard. Note the effective date of the standard is fiscal years beginning after December 15th, 2024, with early adoption permitted. So there's some time to assess the impact of this standard on your financial statements. All right. The next section for our accounting update is related to leases. Technically, this is year 2 of leases, but it obviously was such a significant standard. It's only year 2. I think it's helpful to cover a few key items. In 2023, there was a new standard, ASC 2023-01, which was effective related to related party leases. The biggest takeaway here is that if you have this type of lease transaction, there's a practical expedient that allows your organization to use the written agreements between the two related entities when assessing the impact of this lease guidance. That is a clarification with the new leasing standards. Generally, in high level speaking, related to the lease standard, especially year 2, we're going to see a lot more lease modifications coming into play. So I want to remind everybody that lease modification is defined as a change to the terms and conditions of a contract that results in the change in the scope of or consideration for a lease. Some examples are on the slide here, potentially adding or terminating the right of use asset or underlying assets in the lease contract. It could also be extending or shortening contractual lease terms. Why does this matter? The lease modification is important. It could result either in a separate contract or a change just in the accounting for the existing contract. So this distinction is important with how it really flows through and it's disclosed in all of your financial statements and how it's calculated. So in order to determine if the lease is a separate contract, both criteria on the left of the screen must be present. Modifications that would be granting the lessee an additional right of use asset and the lease payments increase commensurate with standalone price for the additional right of use. So when it is related to a specific and separate contract, you would essentially be recording that as if you're signing a new lease and establishing a new lease contract. Just note, if the lease is not a separate contract, then you would be remeasuring the lease liability for the updated terms and then adjusting that right of use asset at the effective date of the modification. So in that scenario, if it's just remeasuring the lease liability, just noting we wouldn't expect any impact to the statement of activities related to the remeasurement. I know it's brief but helpful, hopefully, to just touch on lease modifications. There are some just reminders related to ongoing policy disclosures. I know a lot of our organizations, a lot of organizations have a policy footnote missing potentially. So there's an adoption footnote in the new lease standard, but it's important to ensure that that new lease standard information is included in a separate policy footnote. This is a quick example of a policy footnote, which would be included in the slide deck. All right, with that, I want to launch our next polling question. Of this information, these new accounting updates, curious which you believe is best in enhancing financial statements. A, leases, 2, the new CECL standard, the new standard on cryptocurrency, or all the above. I'd say the most impact to our audit procedures is probably the lease standard. Definitely had a significant impact and continuing to impact our organizations. All right. And a reminder, we did go through some of these slides rather quickly. And just a reminder to download that slide deck in this presentation to ensure you can refer back to a lot of the content we're covering. Just a few more seconds here on the polling question. Awesome. A lot of the CECL and leases, but all the above seems to be a hot topic. All right, Matt, back to you.
All right, thanks, Ryan. Okay, we're going to talk a little bit about new audit standards. I know there probably aren't a lot of auditors in the room, but again, it's a really good idea to understand maybe why some of the questions are changing this year that you're being asked. There's more emphasis on certain items. There's a number of changes that came through this last year, and we'll go through those. All right. So most of these changes relate really to our planning process, the planning and assessment of at the start of an audit. We spend a lot of time assessing risk, determining what accounts are more risky, what processes are risky, changes in the organization from year to year that may create additional risk. Those are all things we can think about. And these new regulations really kind of change some of the things we're thinking about and how we kind of procedurally go through that process. The first one of which is really estimates, right? Estimates are always an important and sensitive thing. We've historically gone through that. The auditors will go through that with the board to really help them understand what estimates there are and how they may be audited or how they may impact the financial statements. So there's a greater emphasis on assessing those estimates, the inputs into them, the amount of risk involved in them, and then doing look-back procedures to ensure, a year after that estimate's been recorded, was it accurate? Were there any significant changes, things that may have been missed that may impact the value of that estimate? There's also renewed rules around just assessing risk of material misstatement. There's different types of risk. There's control risk, inherent risk, audit risk. For many of you that may have taken an audit class in college, you may remember all those different risks. When you multiply them together, they come up with a significant risk kind of matrix that you want to consider as part of the audit. So moving on, some other auditing standards are coming out in the future or out now include assessment of NOCLAR. NOCLAR is non-compliance with laws and regulations. So many of you that undergo single audits, you're very familiar with that question, right? It essentially creates a more broad rule for all audits now, whether you're a yellow book audit, a single audit, or just a normal financial statement audit, even for a for-profit entity. All right. So moving on. When it comes down to estimates, there were some definitional changes, clarifications. What is an accounting estimate? What is a point estimate versus a range estimate? How do you estimate uncertainty? How do you determine management bias, right? That's one of the big subjects when you're looking at estimates as an auditor, is determining what management's biases might come into play here, right? So if you're trying to, let's say, a statement of functional expenses, the traditional risk with the statement of functional expenses is management wants to push more expenses into programs than other categories, right? Fundraising or administrative costs. And so a bias may mean, hey, maybe we're, square footage is 70% programs instead of 65%. Maybe we'll add a couple more feet there, right? That could be a bias that you have to look out for. And this new rule kind of puts some fences around that and really brings that to the forefront and make sure that we're considering all those biases. As well as outcome of an estimate, right? So you may have a situation where you have a receivable, right, that you didn't allow any kind of bad debt expense for, you didn't record an allowance for, and the next year it's not collectible, right? So was that estimate accurate? Does there need to be a change to the process of that estimation to make sure that you're accounting for all potential changes that may impact it? Okay. All right. So the risk of material misstatement, the biggest thing I want to point out is it separates inherent risk and control risk. Inherent risk is something that's inherent within that account, right? So you have a good example of this separating out these is let's say contribution revenue, right? You have a lot of fundraising revenue, a lot of cash received. There's an inherent risk in that, inflation of revenue potentially, and maybe the controls don't restrict development's access to the accounting system, right? So development has access to the accounting system, and revenue is a risk, right? In the past, we would have said, well, if they don't have access to that system, then essentially there's not a huge risk, right? Because accounting may not be necessarily concerned with showing a higher contribution number, but development might be. And now we have to separate out those considerations and think, is revenue by itself, without consideration of any controls, is that now an inherently high risk account? And then we assess controllers separately. And that may ultimately mean that now there's more riskier accounts, so maybe some more testing required around. What that means for you is that you may have auditors ask for more items, more testing, as a result of just separating out risks during the planning process. All right, so moving on. And again, no CLAR, non-compliance laws and regulations. This mainly has to do with the start of the audit. If you have a new auditor, they'll be required to ask their predecessor audit about any non-compliance laws and regulations, and your predecessor auditor will be required to answer them. So that's something that happens behind the scenes for you, but nonetheless, you should be aware that that's something that's out there. All right, so we have just a couple minutes left. I did get a number of questions related to, so we have a couple minutes, a lot of questions in the Q&A related to uniform guidance and its applicability. So I just want to reiterate here, October 1st is when the new rules go into effect for new grants. So things like the NOFO or spending under grants, things like that go into effect on that date. But there are a lot of items in that new guidance that don't really follow a specific grant, right? Your single audit doesn't really follow a specific grant. Your rules around tracking equipment, your indirect cost rate, de minimis indirect cost rate going from 10 to 50%, those things are kind of separate from grant to grant basis, right? So there are a lot of questions around when these things are applicable. Even things like, if you think about the need to continue to track equipment over 5,000, between 5 and 10,000. Do you still have to track those even after you have a change to $10,000? So these are all questions that we've heard and are out there. Just keep an eye out for the FAQs that should come out from the federal government in regards to how these certain items are applied to your own policies and procedures. It could be in a couple years, it could be a year. We don't know yet. So unfortunately, you can't take that $750,000 to $1 million change right now, but hopefully, you'll see that effect in a year or so. But we'll wait to hear back from the federal government on that. So with that, we are about out of time. So back to you, Danielle. Thank you for being with us today.
Thank you, Matt and Ryan, for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Matt or Ryan directly. Their contact information is in your console. Also, I'd like to draw your attention to the image in the upper right-hand corner of your console. Click this to be taken to more information on our upcoming CECL webcast, which will be June 20th. Hopefully you can join us for that one as well. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Finally, here's a link to our online survey for today's presentation. Thank you again for joining our webcast. We hope you'll join us again next time. Have a great day, everybody.